Okay, Mark Anderson here, construction worker turned zero DT hedge fund manager. Connor, part-time trader, do with his 30 grand account. We wanted to go over kind of Connor's homework for last time. So Connor, if you just want to share your screen and we'll kind of walk through what you found and we'll go over basically like the takeaways of what you found alongside everything else. Okay, so let's start out with the final product and then kind of tell me initially what piqued your interest about this, and then we will venture into the spreadsheet and the individual stages of how you got here.
Perfect. So what initially piqued my interest about this is when I was looking at the prices of the put and the call, I started seeing that when I was around, the 2 mark or on the 2 mark on the put side and on the 150, 175 mark on the call side, I saw that that's where I was getting the best. That's where I was getting the best CAGRs. That's where I was getting the best P&L and the bars and everything that we were looking for. And so knowing that what we ran in the past, so I know we ran a 2 in the past, and that's something that we were normally ripping. I just wanted to test out, like, all right, we usually ran a 2 and a 1, and we both knew going into that was probably going to be a good trade, and we the back test was reflecting that. But the back test popped up a really good. We'll go into this, but it popped up really good results for 2.25 and really good results for 1.75 on the call side. So I was like, what's this happen if I just what happens if I just put these in there? Let's just see if that trade works. And I put that trade initially in there, and it did work on the P&L, and all of this was showing, but it did not perform in 2024. So I was like, all right, how do I make this trade perform in 2024? And I remember you told me you got to throw some volatility in there, some stopping on the volatility for that to happen. So what I did is I put let me see, what did I end up putting on the volatility? I put the max fall at 0.25, and that evened it out. Basically, I was still seeing it actually increased the P&L by like 25,000, and it actually made it perform in 2024 too. So that's really my summary of what I found through the back test. And yeah, want to hop in the back test.
Let's walk through step by step. I actually made some adjustments with this too, because I noticed that even in in high volatility or in low volatility, we seems like we can collect more premium at the beginning. So this is nice that, we're only using $5,000 of buying power. So we collect another $50. That's basically another 1% we could potentially do with it. So let's walk through the steps of kind of what you saw with your testing that went through that. So we'll go through basically like, what was your takeaway or the purpose that you thought of it, and then what was your conclusion?
So on this one, it was excess slippage. I wasn't able to get to all of them, but I did run a couple of them, just the drastic at 0.1 and the drastic at 0.5. And what I saw on here as the excess slippage at 0.25 and at 0.1, there wasn't a big difference, but there's a big enough difference that I just decided to go with the 0.25 because I saw a bigger premium capture rate, and we know that results to more money, so I just went with the 0.25.
This is good here because it's like you're obviously time constrained. You're a regular person that works and has a kid, so it's like you still did the work, but you did it what was most efficient. The other thing too that is good about this is, what do you think this tells us by at 10 cents exit slippage, 25 cents exit slippage, and 50 cents exit slippage, we still have quite a bit of edge in terms of premium capture. So remember, if we go back to our profit is implied volatility minus realized volatility minus commission, slippage, and fees. What was the takeaway that you got from this? And what do you think the purpose of testing this like this was?
Yeah, perfect. I would say that it still performs well at the beginning. When volatility is when the exit slippage is relatively at 1, and it continues to perform pretty well as the slippage continues to rise as well. But I mean, it performs well throughout the whole thing. Like even if you look at point 0.5, like that's not a bad trade at all.
Yeah.
Like
And that's
still
a
does.
huge amount of slippage. So
Yeah.
would you say, like, what do you think this means? Like, what does this trade have a lot of that is shown by it still profits when you have twice the expected slippage?
It just, I mean, it's just it's on. I want to say it's almost like an evergreen trade.
Yeah. That so the thing I wanted to show with this is we have our back test and then we have to match our back test. So the problems with that, and this is kind of what we're going through, is that the more data we filter out and the more filters we have and the less trades we take, the more likely we're going to deviate from the expected result. The second process to that is once we find a trade that's profitable, there's our ability to execute on the trade, which in regards to putting on the trade, we can automate it. That's very easy. But in terms of exiting the trade, we kind of just have to take whatever price the market is because we're cutting our risk. So this basically shows, if our execution gets poorer for no fault of our own because the exit slippage, we just have to pay what we have to pay, it looks like we're still going to make money. Or what this kind of shows is I'll talk about EV, or what I call expected value. So basically EV, or expected value, is a process of the PCR. So even with 50-cent slippage, we have a 21% premium capture, or a 21-cent expected value on every dollar we sell. Does that make sense?
Yeah, that makes perfect sense.
Okay. Now, this one, I kind of anticipated you to now get stuck and kind of like catch on a revelation. So scroll down a little more to where it shows the VIX.
Yeah, this one was confusing, to be completely honest with you.
So can you explain to me like what was confusing and then what you know about the VIX and the ranges of the VIX?
Yeah, so I'll start off with just explaining why it's confusing, because you see the exit slippage. It's almost like, all right, this could be an evergreen trade. It could be something that like it's performing even if our slippage is at 50, which is, like you said, is a drastic slippage. But then I come in here and I was hoping that that would confirm that. Like, of course, that the VIX, and again, what I think the VIX is just it's just a volatility. So, how volatile is the market? And if this is sub 15, I know that that is not a very volatile market. All the way up to above 30, I know it's a very volatile market. So when I'm looking at the premium capture on these and just the results from it, I'm seeing that it performs all right. It performs pretty decent. It actually is not performing. I mean, it performs all right at the beginning, under 15, and then it performs pretty similar. And then
I'm going to stop you for a second here. So I understand you're learning and I gave you a task to execute on, but a lesson that I kind of like is that, like Warren Buffett and Charlie Munger talk about, they'll look at an investment and then they just say too hard, like it's not obvious. So you clearly made an assumption about the first slippage thing, that it looked evergreen and not much affected it. And now here you're confused.
Now it's gone.
So So instead of trying, even though the exercise is to write a conclusion, it's perfectly fine to be like too hard coming back to. And then we may be able to kind of uncover more of this treasure map as we go through the steps. So we can kind of write this one too hard, and then we could try to theorize what this means.
Makes sense. The further we get into the back test.
Yeah. So why don't you scroll down and then show me one that you feel confident you realized some type of trend or conclusion in?
Yeah. So let me see. This one, I realized a trend or conclusion that it performs.
And explain to me what this filter is and what you think it means first. So we kind of have the emotional and thought behind what's it mean, rather than just like we're putting a filter on a filter. So let's try to understand what the process of this is. So what we're doing is we're trying to break this into individualized steps. And once we've understand that concept, we can then kind of contextualize it, and it may help us get insights and other things. And this will take as long as it takes. If you don't know, like, feel free to ask questions or anything.
No, 100%. And again, like you said, for the audience, I want to be able to explain this well. So you can correct me if I'm wrong, but this is the VIX open up and the VIX open down filter, correct? So this is if it changes by 0.2% up, or if it changes by 0.2% down on this one. That's correct.
It's up or down in regards to what? What numbers, what time frames does that up or
is
down?
at the market open of the market of the VIX, correct?
Yep. So, and that's comparative to what? It's the market open comparative to
at the price, right? Is that, or am I wrong on that?
So it's the market open price comparative to the market close price. So the market opens at what time?
9:30.
And the market closes at what time? That's not as important, but
Is it 4?
correct. So this is basically comparing yesterday's 4 p.m. close of the VIX to today's, or the day you traded, open of the VIX at 9:32. So if it was higher than it was yesterday, what is that telling us about volatility risk premium in the market?
Are you talking about this one? Or are you just talking if it was higher than it was yesterday, then it raised the
Correct.
volatility. It raised,
Yeah. And to kind of give you more context about this, in general, the highest amount of volatility risk premium is present overnight. And this is because the market's not open, so you can't transact. So obviously people would potentially want to limit what that risk is for themselves. So if the volatility didn't come out overnight and we're trading 0 days to expiration options, we know that that volatility has to finish or expire by the end of day. So knowing that, what do you think, or you could theorize that the VIX opening up kind of means in context to that?
So can you repeat that just one more time so I can get a good understanding?
In general, volatility is a proxy. Do you know what proxy means? Kind of like a determinant or a predictor of. So volatility is a proxy of risk. So in general, there's a lot of volatility risk premium that is present overnight between 4 p.m. and 9:30. And that is because the market's not open, so you can't transact. So if the market were to move 1%, you can't get out. So in general, so in general, the volatility usually kind of comes out overnight unless it was like a volatile close or something, and then it'll open potentially down. But we also know that since we're trading 0-day options, at the end of day, volatility is now gone because the move occurred and everything that is known, that is known. So
does that mean that there's no risk overnight, or is there?
There's more risk overnight. That's why volatility is generally, it could decrease into the open. You know what I'm saying? Because you can't. Right. So if we're in a marketplace like 0DT where we can actively transact with our stop loss, even though we have the same amount of risk, we have the ability to manage our risk very easily. Whereas in the middle of the night, because we don't have the ability to transact, even though we're holding the same amount of risk, there's more likely risk. So knowing that, why do you think this is a good proxy for?
You got to see how the trade is going to perform right off the open, because when the volatility is at the highest, I know that and I might be contradicting myself by speaking this, but I think you just need to know how is this trade going to perform at the open when I know the volatility lowers, but when the volatility relatively be the highest at the open because of the overnight volatility?
Yeah, so the volatility has to come out eventually. So if it starts at 4 p.m., Thursday, it has to come out by 4 p.m. Friday if it's a 1/0 day to expiration option. So if it didn't come out over those 9 hours, there's probably more volatility that is going to come out during the 6 hours we're trading it now, which looking at this, looking at this statistic, what does this trend kind of tell us?
That's what I was going to get to. So this is the one that I was like, all right, this makes sense to me. It shows me that this trade on both sides, it performs very well at the beginning, at the open meaning. And I mean, it still performs pretty decent throughout the day. On this one, it doesn't perform good. If it's
we lose money, it doesn't work.
Yeah, it doesn't work. But on this one, it performs pretty good at the open.
Yeah, and you can see that. Yeah, it's consistent. So like the kind of concept here is there's like randomness, which is just a bunch of dots.
Yeah.
Like imagine we were on a piece of paper and there's just a bunch of dots. And they're like, okay, how are we going to trade this? You're just like going up and down and connecting the dots. That was basically that test about like days of the week or like random stuff. It made no sense. You know what I'm saying?
Yeah.
Then there's basically like curve fitting. That would be like on Fridays is the best day. And then on Fridays, when the VIX opens up, that's also good. And then, you know, when it's not the last Friday of the month, it's really, really good. So that would be like curve fitting because you're drawing causation between things that probably aren't correlated. And then there's something like this where there's like dots, but they seem to kind of be going in the same trend. So 100%. Instead of drawing the dots, you just draw a straight line through all the dots and you say, hey, I think we're on to something here. Yeah. So it's good that you picked up on that and then you instituted in the filter. So you actioned upon it and then you made a good trade. But now I want to circle back to where you were like thinking kind of hard. So if we scrolled back up to one of the metrics that didn't. So let's look at like the days of the week.
Here we go. Yep. So this one's random too. Yeah.
So this looks random, but now let's theorize maybe why it's so good on Wednesday. You know what I'm saying?
Or is the ball coming out by Wednesday?
Yeah. Or if we were going to, you know, let's try to go back to algebra. In algebra, we have like A plus B, like quotations X is equal to our potential answer. So we know one of the variables in our trade, which is when the VIX is up, that probably leads to profit for us. And slippage doesn't really matter. So if we wanted to kind of like invert this, how do you think we could basically like bust the thought process that Thursdays or Fridays don't work well? What would we test? How would we test that to try to solve for like an individual variable?
So if the VIX is up and we perform well when the VIX is up,
but we don't perform well in this data set on Thursdays and Fridays, how would we potentially prove that it actually works to trade on Thursdays and Fridays?
Would we have to, and I might be overthinking this one, would we have to put it into the back test as assuming the VIX might be down on Thursdays and Fridays and see how it performs? Or
Exactly. Yeah. So that means if we now tested if the VIX, so maybe what this is showing us here is that the VIX just often happens to open down on Thursdays and Fridays rather than Thursdays or Fridays don't work. And we could also say, hey, this probably makes sense because if Wednesday works really good, the VIX probably often opens up on Wednesdays. Mm-hmm. So since the volatility goes way down on Wednesday or way up on Wednesday, it could be down on Thursday and Friday. So to solve for that individual variable to see if we're doing the correct hypothesis rather than just throwing random stuff against the wall, we can basically be like, if we only tested, we're always going to trade all 5 days of the week, but we would test on Thursdays and Fridays when the VIX opens up, what's our result? When the VIX opens down, what's our result? And if those show that it loses money when the VIX is down and it still has like a 20 to 25% premium capture when the VIX is up, all of a sudden we know it's not the days of the week, it's about the VIX. And it just so happens that those days of the week, the VIX normally opens down, which doesn't really.
That's clicking now. That makes perfect sense.
It's like, think about it as like basic algebra. You know what I'm saying?
Yeah. So it's all tied back to the VIX. So it's not really, it's just I don't know if that's necessarily for every trade, just for this trade in particular, it's tying back like that X equation. It's tying back to the VIX in this.
Correct. And what we're trying to do is we're never trying to filter out occurrences or curve fit. But by doing all these particular parameters, we're trying to basically test our hypothesis that no matter what other parameters we work in, the one thing that actually makes a difference is this VIX going up or down.
Makes perfect sense.
I think that was good for today. This trade is good to run. We will start posting the descriptions and getting rolling. It's currently active trading in TradeStewart for like a week now. So we basically have this going, and then we'll get another probably 3 trades, but we'll slowly work all of them in. And then we'll basically get to a point where you've got a full portfolio and then we can share how much money you're making week to week.
Perfect.